The price of oil is well off the highs we saw earlier this year. But how is that impacting the Canadian energy sector? Joining us now to discuss is Menno Hulshof, Managing Director for Equity Research with TD Cowen. And for full disclosure on companies covered by TD Cowen, please see the link to the website at the end of this video. And Menno, of course, we've been seeing some weakness in the price of oil. How has that been impacting the companies that in your coverage universe?
Thanks for having me on, Anthony. I would say that so far it hasn't impacted industry behavior or activity levels too much. I think the bottom line is that most of the E&Ps can generate positive post-dividend free cash flow into the high 40s, low 50s WTI range. So for the most part, they can operate very comfortably in the low 60s, which is where we sit today. I think it's also important to note that the heavy differential following the ramp up of Trans Mountain expansion remains very tight at roughly $12 a barrel. So while WTI prices have been trending lower, heavy oil is performing well on a relative basis. And of course, that matters because heavy oil would account for about 55% of Canadian oil production. In terms of the outlook for 2026, most companies will be issuing guidance in December, and they are already, by all accounts, working through that exercise internally. And if we look at the strip into next year and beyond, the WTI curve is actually relatively flat, depending on the day. And while Western Canadian pipeline takeaway capacity likely won't be constrained for the foreseeable future, we hope there may come a time where it is once again. And against that backdrop, I would expect most companies to remain pretty conservative here. So we're expecting 2026 spending to be relatively flat to even slightly down versus 2025 for most of the large caps, with low single-digit production growth. And then the final consideration here, and this is a point that needs to be reiterated, when you think about balance sheet leverage, those metrics continue to track very low. I mean, certainly the lowest I've ever seen them. So the vast majority of my coverage has tons of financial flexibility should WTI trend down into the mid-50s or even lower.
All right, it's a good backdrop. Now, Prime Minister Carney has touted Canada as an energy superpower and has a highly anticipated budget coming out in November. What will be the things you'll be watching for closely?
Yeah, so I think and I'm going to put a large cap lens on this. I think the big question for the large caps is whether the budget will include pathways and a new pipeline expansion in what we're calling the sort of the second bucket or the second tier of fast-tracked major projects. And having spoken to a lot of the major players, the expectation is that they probably will be. Clearly, having the feds commit to fast-tracking a new pipeline expansion would be viewed as positive by industry. But as you probably know, there is a wide range of views out there as to whether construction of a new pipeline is something that Canada needs. So even with a formal fast-tracking commitment from the feds, there are many, many hoops to jump through to have this become a reality. And, just to give you an example, like I recently heard an industry executive describe the mood as one of skeptical optimism, which I think is a perfect descriptor for the current dynamic out here. Just moving on to pathways, now we're moving on to carbon capture and storage. It sounds like things continue to progress both with respect to the negotiation of the terms with various levels of government and moving the project forward in the background as well. Their work does continue to progress, which not everybody appreciates. In terms of how investors would view this, I would say there is a range of opinions where some would view pathways development as critical to what we call social license to operate longer term. And then others that I talked to would say it's kind of split down the middle. Others would say it's a lower return drawdown on free cash that ultimately shrinks the amount of free cash flow coming back to shareholders. So in terms of how this all shakes out, difficult to call, but I think the various levels of government and industry would like to see pathways sanctioned at the end of the day, and then it's just a question of achieving a fair cost split.
And as you know, capital spending in this sector is critical going forward. Are you seeing any international investors? Are they starting to take more interest in the space again?
Yeah, it's a great question. I would say, yeah, I'm definitely seeing an uptick from the U.S. investor base, and I'm even seeing what I would call a modest increase in European investor interest for the first time in in many years. And I think that's being driven by a combination of factors. And I'll just rattle them off really quickly. First off, Russia, Ukraine, that conflict is ongoing. And I think it has served to tilt the focus back to energy security. And Canada, as a friendly, highly regulated jurisdiction with long life, low decline production and reserves, screens well against that backdrop. And I take it a step further and describe what we're seeing as a first ever bifurcation of the global energy markets, where supply, maybe global supply that is, maybe becomes less mobile over time, meaning that countries could increasingly be forced to choose who they align with as a long-term energy provider. I think the second reason for the uptick in international investor interest is the change to federal leadership, where the new PM and the Minister of Energy so far are largely viewed as a tailwind for Canadian energy, since they both seem to understand the importance of energy to the Canadian economy and are also saying a lot of the right things. The third factor that I would throw out there is growing concern. This is a fairly new thematic. It's growing in concern over inventory depth in several of the major U.S. shale plays, including the Permian. And as I just mentioned, Canada does not have that depth of inventory issue given the long life nature of the assets. And I think all of that combined is on balance increasing overall investor interest.
Are you seeing any other trends on your radar, like consolidation in the industry, deal making?
Yeah, and you mentioned deal making, M&A. That is an obvious one, and we've seen a big uptick in activity on that front in recent years. I think when you think about acquisitions versus growing the business organically, I think acquisitions continue to remain an attractive option for companies, since it allows for growth. And this is an important point. It allows for growth on a per share basis without impacting basin supply. And that matters. And, I'm going to reiterate what I talked about earlier. That matters because we currently do have excess pipeline takeaway capacity. But if we, put the foot on the gas on our organic growth, especially as a large player, you run the risk of filling it pretty quickly, which everybody realizes is not a good idea. So again, inorganic growth, growing through acquisition, is still a very viable option for a lot of companies. In terms of specific deals, the most recent high-profile example of basin consolidation is Strathcona's unsolicited bid for MEG, which then triggered a competing bid from Cenovus for MEG as well. And I just wanted to flag that we should have a better sense of the outcome of that situation on Thursday, since MEG is scheduled to host its special meeting to vote on the Cenovus offer. But higher level, I think we are in the latter innings of the consolidation phase here in Western Canada. And while we likely continue to see plenty of asset level activity, I think the list of larger corporate combinations is much shorter than it was even 5 years ago. In terms of other trends, and this is all fairly recent as well, I've had some questions on whether last week's announcement from Imperial with respect to the 20% cut to its workforce over the next 2 years could be the beginning of a broader trend, especially when you couple that workforce reduction with the broader thematic of deployment of AI, which applies to pretty much every sector out there, but definitely applies to energy as well. I would probably say no, since many companies have already downsized the workforce in recent years. You have to remember, 5 years ago, oil went negative, and that's still fresh in the minds of many. And so these companies are already running pretty lean. So I don't see this driving a significant right sizing of workforces across the sector. And I think it's also important to note that Imperial is 69.6% owned by Exxon, and that the 20% workforce cut at Imperial looks more so related to a larger restructuring decision made by the parent company.
All right, let's go through a couple names that you're finding interest in right now. What opportunities do you see with Cenovus?
Yeah, I mean, Cenovus has been a top pick for me for quite some time. We put it on the best ideas list in September. In terms of what makes it attractive, very simply, it screens very well from a midterm rate of change and valuation perspective. It is exiting a multi-year period of upstream growth spending and downstream maintenance spending, where downstream as you can probably appreciate, has been a big anchor on the stock for the better part of 18 months. But the good news is that U.S. downstream looks to have performed very well this quarter, just based on the market indicators posted on their website. And we are already in the early stages of positive inflection on production growth, U.S. downstream EBITDA, positive U.S. downstream EBITDA generation, and reduced spending. And if you wrap all of that up, that potentially points to a fairly large ramp up in free cash flow in 2026 and beyond, which could potentially further compress its multiple on a relative basis. If you pull up the chart on that, the stock has had a good run since April and has somewhat closed the valuation gap versus peers, but my math would suggest that the gap has the potential to narrow further, contingent on solid execution from the company.
All right, and how about Canadian Natural Resources?
Yeah, this has always been an easy one to pitch. It is a best-in-class name that has the most diverse asset portfolio within our large cap coverage, and that's important because it ultimately drives significant capital flexibility, especially when you combine that with its dominance on regional infrastructure. And the reason I'm putting it forward today is because it has been a big underperformer over the last 12 months, especially relative to names like Imperial. In terms of why we've seen that underperformance, I get that question all the time, and there's a number of reasons for it, but one thematic trade that we've seen over the last year, maybe even a bit longer, has been bullishness on Canadian refining, which has favored Imperial and Suncor. On the other side of that trade, we've seen overwhelming bearishness on oil for a couple of reasons. The obvious ones being global oversupply concerns and even demand concerns, given ongoing global tariff disputes. And on balance, I think that combination has probably hurt Canadian Natural from a funds flow perspective. But at the current share price, I think you're getting, as I talked about earlier, best-in-class producer at a very reasonable valuation and a 5.2% dividend yield, which is all the more notable since it is a dividend aristocrat. And then finally, just putting a more near-term lens on the company, I would note that it will be hosting an investor day in early November in Toronto, and that is going to be its first major investor day since 2022. So hopefully we'll see some positive updates coming out of that event as well.
All right, when you look at those two companies, what are some of the potential risks that you see to your target prices on those stocks?
Well, I think for Cenovus, it's just a function of execution. I think they have a very clear track over the next year in terms of what they can achieve, and I think the first piece of that we'll see this quarter with a move from negative U.S. downstream EBITDA generation to positive. That's the first time we'll see it since Q2 of last year. And then they've got this very deep portfolio of growth projects that they are in the very early stages of ramping up. If they can deliver on all of that, I think that is going to serve the company well from a funds flow perspective. Canadian Natural, the execution has actually been very, notwithstanding the underperformance over the course of the last year, the execution has been very good. I think it has been fallen victim to sort of broader thematic trends, which I talked about earlier, and maybe a relative lack of catalyst. But I think if you can be patient with this one, I think there's quite a bit of relative upside.